the world's an interesting place at the moment. Markets have been very volatile. And I think that probably leads us into a very important point is why have we chosen to be more active at the moment in regards to equity portfolios?
So I think in terms of thinking differently and how we look to set up portfolios, and again, like we can't we don't have crystal balls. We can't make explicit forward assessments on exactly what will happen. But I think with regard to how markets have been traversing over the last couple of years, we've been fairly consistent in our comments around the fact that the markets have been very momentum driven and one directional, and then feeding off that very concentrated sort of focus on what's winning and what's not. And so obviously, I mean, that goes against hundreds of years of investing in terms of what does play out in markets. So you've got two options at that point when you're in the middle of it. You can adjust and try and make some short-term gains, or you can invest for the long term in terms of tried and tested approaches and make assessments along the way. And I think if we think about portfolios today, obviously we are being more active, not just in terms of our approach, but in terms of our review, our communication and commentary and discussion amongst what's happening. And obviously in relation to our monitoring of underlying fund managers as well in portfolios and what they're doing. They're technically our first line of defense. When you are using active managers, you do get the benefit of them providing that first quick line of defense where they can move things very quickly and very swiftly as they see things firsthand. And then obviously we take stock of that and assess whether we need to make any other explicit changes from a portfolio perspective.